And I think we're about ready to start. So good afternoon, everybody, and welcome to today's financial reporting webinar brought to you by Shinewing Australia. We're delighted that you can all join us today. My name is Tom Malarkey. I'm an Associate Director in the Assurance and Advisory Division, and I'll be moderating today's session. The topic for today is removal of special purpose financial reports. So I don't know if we've got many on the line who can recall about 15 years or so ago when Australia transitioned to IFRS for the first time. That was a significant change, required a lot of preparation. Well, for those impacted by this change, I think you're talking about a change of the same magnitude as back then. So it's an important topic. But we're lucky today. We've got Renee Muller from a partner in our audit division, and Jimmy Chow, an associate director. They've been leading the initiative to understand the requirements and to help our clients to plan and prepare. So we're in good hands today. They've got lots of tips and insights to share with us all. Now, before we start, there are a couple of housekeeping matters. We will be running a Q&A today. So there's a Q&A button at the bottom of your panel. If you open that up and draft your question, you can submit it to us and we will endeavour to answer the question during the session. If we can't answer it during, we'll try to answer afterwards. We'll also be running some polls today. So I think the first polling question should just be popping up on your screen about now. As soon as you answer those questions, the pop-up will disappear and I'll come back later on in the session with the results of those questions. So first question is around the framework you're presently applying to your financials, which is a very important consideration, because depending on how you're currently preparing your financials will determine the starting point for you in terms of the path to transition to general purpose. And our second question is, we're curious to know how many of our participants are considering early adopting. Jimmy and Renee will talk about early adoption, and there are some really good reasons why you should consider and why you should do that. So without further ado, I think now I will hand over to Renee Muller and she will get the presentation on the way.
Thanks, Tom. Great to be here today and great to have so many of you on the line today. This is quite a hot topic at the moment, and a lot of people seem to be quite interested in talking about it. And the reasons for that is because a lot of entities are likely to be quite impacted by this, and it might be a significant change. Not everybody will be significantly impacted, but it's best to just know and plan. Because a lot of entities, when we talk to a lot of our clients about this and we ask them, do you understand the requirements? Are you prepared? A lot of them seems to think this is next year's problem. I've got enough to worry about now. I've heard about it, but I've not looked into it because it's not mandatory until next year. Well, that might be the case, the mandatory bit, but there could be potentially be significant benefits to early adoption. So what I'd like you to get out of the session today is, first of all, what are the changes? Does it impact me? And will there be a benefit to me for early adopting? So some of the things that we'll be covering today, we'll look at the difference between special purpose reporting and general purpose reporting. We'll have a look at who will be impacted, what the dates are that you need to be aware of, what the incentives are to early adopt, and then we'll talk about how you actually move from special purpose to general purpose reporting. Some entities will continue to be able to prepare special purpose accounts, and we'll cover those. And then we'll give you a summary of some of our key takeaway points today. So the first thing I want to talk about is why change? Why fix something that's not broken? I think a lot of people might ask. Well, the International Accounting Standards Board issued a revised conceptual framework. And in the revised conceptual framework, they included a definition of what a reporting entity is, which was not previously in the previous version of the conceptual framework. Now, the conceptual framework forms the basis of all accounting standards. So if you comply with accounting standards, you should be complying with the revised conceptual framework. So the definition in the revised conceptual framework, which will be mandatory from 1 July 21 in Australia, is a reporting entity is an entity that is required or chooses to prepare financial statements. So that basically means anyone that prepares, because you're required or chooses to, prepares financial statements will be a reporting entity. Now, previously in Australia, our definition of a reporting entity was defined by SAC 1. And therein you had an ability to self-assess whether you're a reporting entity, basically looking at the users of your accounts. So if you had users of your accounts that needed general purpose accounts, then you self-assess yourself as a reporting entity. But this removes that self-assessment element, and it basically says if you're preparing accounts, you're a reporting entity. I should also mention at this stage that Treasury did double our large proprietary thresholds in Australia. And this wasn't coincidence. This was kind of timed to match this revised conceptual framework, because Treasury has long been of the view that a lot of companies self-assesses non-reporting when Treasury would consider them to be economically significant. And so they've come out and they've said, if you are a large proprietary company under these new thresholds, you probably would be considered economically significant, and therefore you probably would be a reporting entity. So that's another thing to be aware of when you're talking about whether you're a reporting entity at 30 June 21 and beyond. So what are general purpose financial statements? So we've got three kind of elements of financial reporting we look at. One is recognition and measurement. So that's the numbers in the accounts. The second one is consolidation and equity accounting. So that is, do we look at the group overall, or do we just report on a standalone entity basis? And the third element is disclosure. So why do we put in all those notes in our accounts? Now, a tier 1 entity fully complies with all recognition and measurement. It has to consolidate if it has subsidiaries, an equity account, joint operations and associates, and it has to comply with all the disclosure requirements of all the standards. Now, a tier 2 entity, they can apply the Simplified disclosure standard. So that's a new standard in Australia, and that's our new tier 2 standard. So that's AASB 1060. So we call that Simplified Disclosures, or SDS for Simplified Disclosure Standard. And what does a tier 2 entity need to do? Well, they also need to comply with all the recognition and measurement requirements. Consolidation and equity accounting, that will be required going forward. So in the past, consolidation and equity accounting was not considered recognition and measurement by a lot of entities. It was always debated, but it was never clear cut whether it was. So a lot of special purpose reporters chose not to comply with consolidation and equity accounting. And disclosure for a tier 2 entity will be AASB 1060. So that's the SDS standard. And that was based on IFRS for SMEs. So when it became clear that special purpose reporting will no longer be an option in Australia due to this reporting entity concept change, the AASB went on quite a long consulting process, and they spoke to a lot of stakeholders, and they went through a few different proposals of what a revised tier 2 framework in Australia would look like. So our current enforced tier 2 reporting framework is the Rdr Framework. So that's General Purpose Financial Reporting Reduced Disclosure Regime. And the question that the AASB put to the stakeholders are, should we continue to apply RDR as a tier 2 framework? Should we come up with something completely different? Should we adopt IFRS for SMEs? And in the end, what the AASB decided after quite a lot of consulting was to adopt IFRS for SMEs, but make a couple of tweaks to fit into an Australian environment. So what they decided to do was try and minimize those tweaks. So once the SDS standard, the Simplified Disclosures, become our mandatory tier 2 financial reporting framework, a lot of clients have asked, can I still do my RDR accounts? I've been doing it for the last 5 years. We've just got on top of exactly what we need to do for RDR. Can I continue to do it? Well, the answer to that is SDS is expected to be slightly less disclosures than RDR. So if you want to roll forward your RDR set of accounts, and you add in just a couple of tweaks for some bits and pieces that's Australian specific, like audit fee, imputation credit, etc., your RDR accounts will probably comply with our current SDS framework. However, going forward, the AASB is not going to maintain our RDR paragraphs in our standards. So at the moment, the RDR paragraphs are the grey shaded paragraphs in all the different accounting standards, whereas the Simplified Disclosure Standard is one standard that covers every single thing that you need to disclose if you're a Tier 2 reporter. So that's like an elaborate, quite a long disclosure checklist. So it's simpler to use. So what I'd say is if you do just roll forward your RDR accounts and make a couple of tweaks, RDR will not be maintained. So if there are major changes to accounting standards, that won't be reflected in the RDR paragraphs. So it's not a long-term solution. And also IFRS for SMEs is currently being reviewed by the International Accounting Standards Board. And we are expecting them to make some changes to IFRS for SMEs, which I think that we're quite likely to adopt so that we don't in the long term have to have a large team in the AASB who looks after our own Tier 2 standard. So it's quite likely that changes to IFRS for SMEs will be reflected back in our own simplified disclosure standard. So my recommendation would be if in the first year you're struggling to get on top of the new simplified disclosures framework, sure, rolling forward your RDR set of accounts and making a couple of changes would be okay, but in the long term, probably best to transition to simplified disclosures. I'd just like to remind you at this stage, if you want to ask a question, you can pop it into the Q&A box. We'll try and get back to you during the presentation, but anything we don't get to, we're happy to respond to afterwards. So feel free to send us some questions. So what's the difference between an SDS Tier 2 set of accounts and our current special purpose framework? So if we look again at the three different areas of financial reporting: recognition, measurement, consolidation, disclosure. So a special purpose framework at the moment, a lot of entities are complying with recognition and complying with recognition measurement, especially if they're lodging their accounts. So we'd expect most special purpose reporters to comply with recognition measurement, but it's not guaranteed. So some special purpose reporters still have their own accounting policies. Consolidation equity accounting, well, like I was saying earlier, this will be required for a Tier 2 general purpose preparer, but a lot of special purpose preparers did not consider consolidation to be a recognition and measurement issue. They considered it to be a disclosure issue and therefore a choice. And so a lot of them didn't comply with it. So that's going to be a big change. And disclosures, a special purpose set of accounts, you can choose what you want to disclose, whereas SDS will be a lot more prescriptive. So we've got that long disclosure checklist in AASB 1060, whereas a special purpose set of accounts didn't have any kind of disclosure checklists. So when it comes to recognition and measurement, and then consolidation equity accounting, what are we seeing as the big challenges for entities moving from special purpose to general purpose accounts? So like I was saying, most special purpose preparers do at least try to comply with most recognition and measurement. My understanding from some discussions I've had with ASIC and the AASB and so on, there's still a lot of companies that actually don't fully comply with recognition and measurement, even when they lodge their accounts. So some of the areas that some special purpose preparers might want to pay a bit of extra attention to would be the more complex areas like lease accounting, financial instruments, revenue recognition, intangible assets, and how they account for their tax. So a lot of companies special purpose reporters in particular, would have an accounting policy that's not necessarily fully compliant with all the recognition and measurement requirements. And this is going to be a challenge to get them up to speed. But the big area where we see challenges will be around consolidation. So a lot of special purpose preparers in the past will have lodged the parent entity set of accounts if they're large, and maybe the large subsidiaries if there are large subsidiaries. Going forward, that would need to be a consolidated set of general purpose accounts, Tier 2. And that's going to be a challenge for a lot of companies who've not previously consolidated. In particular, if you look at some of the subsidiaries in the group, might have been acquired recently or in the last couple of years, might not have been large, might have their own accounting policies that's not in line with those of the group. And some of the subsidiaries might not be compliant with all the recognition and measurement requirements. So before you even think about consolidating a new group or a group that's not previously consolidated their financials, you might want to go through an exercise of checking whether the subsidiaries are compliant with the recognition and measurement requirements and whether the accounting policies are consistent across the group. So who will be impacted by the new requirements? Now, for now, I'm only going to be talking about for-profit entities, not because not-for-profits are getting a free pass, but because the not-for-profit transition from RDR to SDR, we're still waiting for a standard to be issued. I'll talk about not-for-profits a little bit later. So let's just talk about for-profits for now. So if one of the two criteria are met, so there's two things you need to look out for when you're considering whether we need to move to general purpose reporting. One is if you're required by law or a regulation to prepare accounts in accordance with Australian accounting standards, those will need to be general purpose accounts. So a large proprietary company, a small foreign owned entity, an Afsl holder, those entities are required by law and regulation to prepare financial statements that complies with Australian accounting standards. Those accounts will be general purpose. Or if you have a document such as a constituting document, like a trust deed, a partnership agreement, etc., that says this entity has to prepare financial statements every year that comply with Australian accounting standards, that needs to be general purpose accounts. Now, there is a grandfathering exemption there, which I'm going to talk to in a second. Or if you have another document, such as a loan agreement or a bank covenant, etc., that says we want to see a set of accounts every year that complies with Australian accounting standards, well, that is general purpose accounts. So in a nutshell, if you prepare financial statements that comply with Australian accounting standards, that is general purpose accounts. So the grandfathering concept is applicable to entities such as trusts, etc., that might have a trust deed that says you need to prepare accounts annually, and these accounts need to be in accordance with Australian accounting standards. Now, if that trust deed was in place before 1 July 2021, the AASB has given you a grandfathered status, or if that trust deed is created or amended after 1 July 2021. So if a trust deed is going to be amended for a couple of tweaks here and there, make sure you double check what type of accounts that entity needs to prepare based on the trust deeds, and make sure that you don't create yourself a situation where you have to prepare accounts with excessive requirements if that's not what the entity wants to do. So that's that 1 July 2021. That's the key date there for grandfathering for a trust deed. So while we're talking about the grandfathering concept, I also just thought I'll just throw in there a large proprietary company that meets the grandfathering requirements. So a grandfathered large proprietary company doesn't need to lodge accounts. However, they do need to prepare accounts in accordance with the Corporations Act. So those accounts would still need to be general purpose. So when we talk about the documents, such as a trust deed, for example, we've actually had quite a lot of questions from clients asking, so what am I supposed to put in here? Or if I have a trust deed that says this trust needs to prepare annual accounts that complies with generally accepted principles, does that mean it has to be general purpose? So I think the first thing you need to consider is, what does the entity want to do? Does the entity want to prepare a set of accounts annually that is compliant with, that's quite, prescriptive framework? Then you should say that entity needs to prepare accounts in accordance with Australian accounting standards. It's a prescriptive framework. You know what you'll get. Whereas if the company or the entity wants to use more judgment in what they put in the accounts, then it's probably best for the wording in a newly created trust, for example, to say the trust has to prepare accounts every year that complies with generally accepted accounting principles. And that gives you an element of choice as to what the accounting policy should be. As long as you don't put in those accounts then that they comply with Australian accounting standards, as long as you say what you're doing, so these accounts comply with the accounting policies, then that should be okay. So what's the timeline? So the mandatory date will be 30 June 2022. So, and if you're a December reporter, normally December goes first, but in this instance, December goes after. So 30 June 22 or 31 December 22. At that date, this new standard is mandatory. So if you're preparing special purpose accounts, 30 June 21 or 31 December 21 will be your last chance to do special purpose accounts if you love your special purpose. So the question is that next year's problem? Well, 30 June 2022 might not be the best date for you to transition, because if you adopt this for the first time in 30 June 2022 and you've never done a consolidation before, you are going to need to do a 30 June 22 consolidation as well as the comparative, so 30 June 21, plus you'll need your opening consolidation done as well, so that's 1 July 2020. So if you've done standalone accounts with standalone orders before, that means you'll probably also need to get those consolidation workings and financial statements audited. So you'll have to reorder the consolidation if you've not done a consolidation before. So what happened when this standard was issued? The AASB wanted to make it mandatory a year sooner, but a lot of stakeholders, a lot of preparers, a lot of the accounting firms said, you're not giving us enough time. There's not enough time. So what they did was they said, okay, we'll push it back by a year. We'll say it's mandatory from 30 June 2022. But if companies early adopt, then we'll give them some significant benefits. We'll give them some areas where they'll save a lot of time and effort if they early adopt. So this incentive to early adopt, if you early adopt and you're consolidating for the first time, you might have some strange looking accounts. Okay, so what the biggest incentive is to early adopt is you don't need to restate your comparatives if you adopt, so last year or this year. So 30 June 2021, if you're deciding to early adopt SDS financial reporting, so general purpose reporting rather than your special purpose accounts, your current numbers for your balance sheet and your P&L will be 30 June 2021 consolidated, whereas your comparative numbers will be what you had in your last standalone set of accounts and your special purpose accounts, right? So it'll be the parent entity numbers in the comparative column and the consolidated numbers in the current column. It'll look strange, so it'll be a strange set of accounts for the first year, but it's an enormous benefit not having to restate, 2 more years of comparative consolidation in your accounts. And in terms of the notes, so your disclosures and so on, if there are new disclosures in your Tier 2 SDS set of accounts that you didn't previously disclose as a special purpose reporter, you don't need to put the comparatives in. So you only need to put in the comparatives for the items that you previously had in there anyway. But anything new, no comparatives required. So that is a significant benefit to early adoption. So Tom, I wonder if you've seen a lot of your audit clients talking about early adopting or having early adopted already.
Yeah, some of them have. I think initially people are reluctant with any change to, they prefer to do it next year, but a lot of them now, they're starting to see the benefits and they're starting to consider whether early adoption is right for them. So I think it's starting to grow on people.
Yeah, I've seen the same with some of my audit clients. Some have already adopted last year, especially if they needed to consolidate for the first time.
And just looking at the results of the poll, I thought there'd be more no's, but about a third of the respondents say no. Quite a few people are undecided, about half. And there's about 15% or so that said yes, they are going to early adopt. So I think the benefits people are starting to realize. So I think that's good. That's advisable. I have a few questions for you, Renee, actually, if that's okay.
Mm-hmm.
You mentioned during the session that Treasury had said that large proprietary companies reporting under the new thresholds are economically significant, but I do know some of our audit clients are still self-assessing as non-disclosing under the old requirements. Can they still do that?
Yeah, so when Treasury came out and said that, it's their view that a large proprietary company under the new threshold is probably a disclosing entity, they didn't work that into the legislation. This was just some of the information they said. So it's not a 100% guideline. If you're a large proprietary company, you're a reporting entity. Companies can still self-assess under SAC 1. So SAC 1 is still in force for 30 June 2021 and 31 December 2021. So if you self-assess yourself as a non-reporting entity, what we're advising our clients at the moment is to make sure that's just documented again, given the larger thresholds. So just redocument it, recheck with the board that they're happy to continue to be a non-reporting entity, and just make sure it's documented properly.
And the other question I had, if it's okay, special purpose preparers who are already consolidating, is there any benefit to them to early adopt?
So if you're already consolidating, you need to consider whether your subsidiaries in the group all have a recognition and measurement that's in accordance with all accounting standards. So if your recognition and measurement of, across the board of all the entities in the group are not in line with the recognition and measurement of all accounting standards, there might still be a benefit to early adopting, and Jimmy will go through that in a little bit more detail. So I think that'll become clearer once Jimmy's gone through how to move from special purpose to general purpose reporting.
Okay, thanks for that, Renee. Just before we come to Jimmy, we are going to launch the next two questions, or next two polling questions. So hopefully they're popping up on your screen now. So the first question is around WSB1 first-time adoption, which I mentioned at the top of the session. It's important, we're going to need to dust off this standard and refamiliarize ourselves with it, because it is going to be the vehicle through which we transition. And the other question then is around, what issues or concerns do you have with transitioning? So keen to hear from the responses to those questions. So we'll come back to those polls later on in the session. So with that, I think now we can introduce Jimmy Chow, and he's going to take us through the next part of the session.
Thank you, Tom. Yeah, so Renee has told us about the requirement, who is going to be affected, and what's the significant benefit of early adopt. So now comes to actually doing it. If we decide we want to adopt the new standard, we are going to move from special purpose to general purpose. What do we need to do? So I bring back this beautiful chart again. So for the three categories, the first things you still need to do is make sure your number is right. You make all your recognition and measurement is in line with the accounting standard. Then move down to if you need to consolidate or if you need to do equity accounting, you need to do that. And of course, we'll have additional disclosures that need to be put on the books. So assuming we are not early adopting, now come to 30th June 2020, that's my current year. So when I actually have to move from a special purpose to general purpose, what do we do now? So the standard actually requires you to state your comparative figures. That means year -1. So you need to make sure your comparative is in line with the accounting standard. You do need to do the consolidations. And in addition to that, you also need to restate the beginning of the comparative year. That means year -2. So you have these 3 years balance sheets in line, and then you will disclose what are the things that you have done to those. So just give you an example. If a company has acquired a business about 5 years ago, and they didn't really do the full accounting, the full acquisition accounting, they just simply say, oh, I pay this money, this is my goodwill. So now I need to account for these transactions. What do I do? So there is 2 approaches. So the first one is to just go back to the 5 years and work out what is the correct accounting treatment at that time. You do your full purchase price allocations, you do all your fair value accounting 5 years ago, and work it out how it's going to be the impact to my opening balance sheet, that means year plus 2 years ago, work out the impact, and then report whatever things has changed in your notes. So let's just call that normal approach. That's AASB 108, change accounting policy, a correcting error. So that's the normal approach. And a lot of people say, hey, that's actually very hard. What if I have a transaction happen 10 years ago? The management has changed. We don't have all those books and records. How do we do it? So that's where the sweetener come in. So the accounting standard does give you some shortcuts. They understand it is hard to do that transition if you have to go all the way to the transaction date. So you can choose to use AASB 1, first time adoption of Australian accounting standard. So what does AASB 1 entail? It's basically you go back in time, fix up everything with quite significant exemptions. So those exemptions is to help you to save time and effort. And I'm going to tell you quite a fair bit of those who is going to save time. And also under AASB 1, the disclosure requirement is less onerous as compared to the normal approach. So we have been just give you a little bit background of AASB 1. So instead of just showing you all the mandatory exceptions, voluntary exemptions, those numbers are big. And I promise you I'm going to show you in a second. I would just want to give you the overall objective for you to better understand this accounting standard. It is a fairly difficult accounting standard, to be honest. So the overall objective of AASB 1 is really to provide the balance between comparability and transparency. That means go back in time, fix up everything. Your comparative figure is exactly the same as your current year. You know, that's adding a lot of value to the user of the financial statement. Or how are you going to spend the right amount of cost and produce the right amount of information? So AASB 1 is pretty much to strike that balance. So included in the standard, there is mandatory exceptions. So what are they? So it's mandatory exceptions for you to go back and restate everything. That means don't do that. Don't restate this kind of things if you're under those circumstances. The reason is, in some circumstances, if you go back and restate it, it's subject to manipulation. That's a strong word, but it will potentially inappropriately change the comparative. So one very important example is estimate. So if you have historically make an estimate 2 years ago, under the whatever framework you are under, if you are in compliance with your accounting policy and you make an estimate, so you are supposed to stick with that estimate. So if you say, okay, we have this legal case 2 years ago, I don't believe we need to pay anything. So you make an estimate not to book in a provision. So you are not allowed to go back in time saying, oh, actually now know a little bit more information. The case settled 2 years down the line. So I'm now going to book in that provision. You are not allowed to do that. So that's a very important mandatory exception to remember. And there's some other items, a lot of them is to do with financial instruments. And then come down to the second category, which is voluntary exemptions. So that's where you can take some shortcuts. So on the screen, I now show you a list of mandatory exceptions and a list of voluntary exemptions. So we have talked about the estimate. I'm going to tell you about the most popular one that we have seen, like our client really think it's going to save them a lot of time and effort reproducing their comparative figures. So the first most important things is business combinations. So if I have an acquisition 5 years ago, what do we do with it? Do I go back in time, restate everything? Yes, you can. So before I jump in to tell you what is the exceptions, what can you do, what's the shortcut, let me just give you a 2-second recap of what you normally do with the business combinations under the accounting standard. So basically, the accounting standards say when you acquired a business, you need to fair value the assets, fair value the liability. So whatever left over is going to be the goodwill. But hold on a minute, you do need to see if there any further component in the goodwill that you need to spit it out. That can be a brand name, intangible asset, or it can be a customer list, or be any other intangible asset. Then you need to account for those separately from the goodwill, and then the remaining is going to be your goodwill. So very fair value accounting heavy, everything's fair value. So do I then need to do this to all my business combination if I now transit from special purpose to general purpose? The answer is no, you don't have to. So you can choose under the accounting standard to do everything, all the entity, all the business combination you acquire, you do fair value accounting, go back in time and restate it, that's fine. Or you can pick a date, and from that day, any new acquisition, you will do acquisition accounting. That's also an acceptable approach. And then come to, no, you don't have to do anything. On transition day, like the day 2 years ago at your opening balance sheet, you just do book value accounting. So let me just give you an example, very simple example. The company XY acquired a subsidiary in 3 years ago. So they paid $2 million in the acquisitions. And when they take over the books, the book value of the net assets is 1.5 million. So the net asset, all the assets and liability is actually in line with requirements of the Australian accounting standard. So there is a unique feature there. If you are not, you do need to adjust your opening return earnings to make sure those numbers are in line with the accounting standard. So in that case, I have a balancing figure of 0.5 million. So if you are not go back to restate, this 0.5 million, this $500,000 just become your goodwill. So if you have historically account for these things as a brand name, let's say you say, I have this balancing figure, it's my brand name. So what do you do when I transit from special purpose to general purpose? So the accounting standard just say, okay, you just lump all your intangible asset. That's not the intangible asset cannot be stand-alone account as an asset from the accounting standard perspective. Put that intangible asset into goodwill. So that's how you move a business combination upon first time adopting the AASB. So if you have a subsidiary that you have not historically consolidate, so in your separate financial statement, you have an investment in subsidiary and you run 2 books. You have one set for the parent company, another set of books for your subsidiaries. So what do you do? So the concept is very similar as the business combinations. So what you need to do is to bring the subsidiary books up to recognition and measurement criteria of the Australian accounting standard. That means all the lease on balance sheet, all the accrual accounting. Once they are bring up to AASB, then you work out what is the net book value and take the net book value out from the investment. That becomes your goodwill. So you can see that's a huge difference as compared to going back to do all the fair value accounting. And a lot of the client think it's really going to save them a lot of time. And also just a quick reminder, this is also applied to if you have to do equity accounting. So this exemption is also applicable to them. So now we talk about the business combination and unconsolidated subsidiaries. The next very popular exemptions is deemed cost. So what is the deemed cost? It's basically allow you to move from fair value. You can use the fair value of your property, plant, equipment. If you own a property, if you own a factory, you can use the fair value as your new cost. So the accounting standard does allow fair value options when you are valuing your property, plant, equipment, but come with the fair value requirement. You do need to do your annual valuations process, either be a director's valuation or third-party valuation. So this particular exemptions allow you to use fair value, but without the ongoing compliance requirement. So that's actually very attractive, especially to some of the company. They believe when they have, if they have a bigger balance sheet, they might have a better chance securing some financing. So this deemed cost exemptions is going to be applicable for those entities who wish to use fair value. And also, this is not only just applied to property, plant, equipment. You can also apply that to investment property as well as some intangible assets. And the next area, a lot of people ask us, we heard about the new leasing standard. Everything's supposed to be on balance sheet. So we haven't done that, but we are now moving into general purpose financial statement. We believe we have to do lease on the balance sheet. So how do we do it? Is there any shortcut for us? The answer is yes. The ASB 1, they pretty much provide the same shortcut, same transition relief when people first time doing ASB 16. So the most significant one, in my opinion, is you don't need to retrospectively account for your lease from day one. So what you need to do is on the reporting date, work out what is the remaining lease liability, and you can simply flip that into your right of use asset. So your asset and your liability is the same on the transition date. That saves you a lot of time going back in time, redo everything. So these are the three very popular voluntary exemptions that we believe will save time and effort. So a lot of people then come talk to me saying, hey, Jimmy, that's great. Can we now use fair value? Can we just do it? Like, we are now special. If we move to general purpose, can we just use fair value? Not so quite. So the ASB 1 only applicable to those companies who has previously not in compliance with recognition and measurement of the Australian accounting standard. So you can't just kind of free flow using all those exemptions. You have to understand what's your basis of preparations and how do you move from special purpose to general purpose. So I talked to you quite about ASB 1. I do want to hear from Tom. How is our audience response to our polling questions?
Well, about half respondents are somewhat okay with using the standard. Surprisingly, 22% say, yeah, they're comfortable, they're okay, and the rest said no. So there you go. Before we move on, Jamie, I have a question for you, if that's okay.
Yeah, sure.
I do know from experience, when clients look at their accounts from a different angle or from a different perspective, oftentimes it can show errors or mistakes that were missed in the past. Now, if we're transitioning to a new to general purpose, and we're also trying to deal with errors, I can imagine it can get very messy. So what can people do if they uncover errors through this process?
Oh, absolutely. So in fact, ASB, when they come out with the new requirement, when they remove the special purpose, they have thought about this. They know how much effort goes into it. So they don't want to put in additional burdens. So what they have essentially say is, when you discover errors in the process, when you're transiting from special purpose to general purpose, it don't need to separately disclose it. Just club it into together with changing accounting policy and just report whatever things that you have fixed. So in the other words, it's kind of a good opportunity to clean up some of the legacy issues.
Yeah, exactly. Yeah, that's a great exemption. Thanks for that, Jimmy. And I think I'll hand over now to Renee. She's going to round out the session.
Thanks, Tom. So if you're thinking, oh, I'm sure my entity will continue to be able to prepare special purpose, if this is what you've been hanging out to hear, who can still do special purpose going forward? Well, if you don't fall into those two categories I mentioned in the start, so if you're not required by law or regulation to prepare accounts in accordance with Australian accounting standards, and you're not required by a document such as a trust deed or a bank agreement to prepare accounts in accordance with Australian accounting standards, you can do whatever you want. So you're basically only preparing accounts for yourself. Even if you get it audited, you can put whatever you want in there. You can have your own accounting policies. You can say we comply with the recognition and measurement of 2 or 3 standards. The rest we do our own. Or you can do full general purpose accounts if you want. But if you don't fall into one of those two buckets, laws, regulations, or a document, you can do whatever you want in your accounts. No one's going to come looking at it. No one's going to worry too much about it, as long as you say what you do. So you can choose a presentation that you consider the most appropriate. So you can say our accounts are full general purpose, and you can say it complies with IFRS, if that's what your accounts do, or you can say special purpose. You can say it only complies with accounting standards. Just don't hold your accounts out to be compliant with Australian accounting standards if they're not. So that's basically the good news for those who fall into the small private company space, maybe you don't need to lodge their accounts, etc. Now, I said at the start, I'm going to talk a little bit about not-for-profit as well. So at the moment where we're at with the not-for-profits is a lot of not-for-profits are already preparing Tier 2 financial statements. So not-for-profits typically tend to do RDR accounts rather than full general purpose. And there's a much lower threshold in terms of who needs to prepare general purpose financial statements in not-for-profit space. So what the not-for-profits came back with to the AASB after issuing the standard and the incentives to early adopt is the not-for-profit said, well, if we move from RDR to SDS, we don't really get any benefits. So where's our ability? Because there's no real incentive for a not-for-profit to early adopt if they're already doing RDR accounts. So they've said, where's our incentive to maybe not have to disclose information we've not previously disclosed if we're moving to a new framework? So the AASB is currently going through a consultation process to determine what the not-for-profits are going to do in terms of transitioning. So at the moment, a not-for-profit entity can choose to continue to prepare RDR accounts, or they can apply SDS if they want. So they've got a choice on what they want to do, but we don't yet know what kind of transitional benefits might be available to not-for-profits down the track. We're waiting to hear back from the AASB on that. We also know that the ACNC is looking into what they expect from not-for-profits, what the not-for-profit tiers should be, what the financial reporting framework should look like for not-for-profits. So we're still watching that space a little bit, but you do have a choice at the moment, RDR or SDS. While I'm talking about not-for-profit entities, I thought I might also just make sure, if you're not aware, that there's a standard AASB 2019-4 that's specifically for not-for-profits, and that's some entities might have missed last year, so it was already a 30 June 2020 issue. And I think we've heard anecdotally from the AASB, etc., that they consider a lot of entities might have missed this new standard, which requires additional disclosures of not-for-profit entities. And these additional disclosures, if you have any questions about it, please give me a call afterwards. But these additional disclosures are around what recognition and measurement of the accounting standards you comply with, whether your accounting policies are in line with accounting standards, etc. So just some additional disclosures on your own framework. So the key takeaway points from today's session, and the main thing I kind of want people to leave with here today is that it's not just a disclosure standard. This is not just about We had a template that we popped our numbers in, and now we need a new template that we pop our numbers in. It's also a process of considering whether your accounting policies are in line with the recognition, measurement, consolidation, equity accounting, the full requirements of the accounting standards. So that's a good opportunity, as Jimmy said. It's a good opportunity to clean up some legacy issues. Bit of a clean slate as well if you early adopt this. Transitioning to AASB for the first time can be challenging if you've not previously complied with all the accounting standards, the recognition and measurement. Then changing your accounting policies could result in some significant restatements, and that can be quite challenging, not just in terms of calculating what the adjustments are, but also working through those restatements with stakeholders. The main takeaway I think that most people might get from this, though, is that there are significant early adoption incentives, but not everybody will get early adoption incentives. So if you've historically complied with recognition and measurement, and if you've historically done a consolidation, or you don't need to do a consolidation because you're a standalone entity, there might not be any significant benefits from early adopting. And if there's no benefit to you, I wouldn't recommend that you do early adopt. And there's some options around fully retrospective, take some shortcuts, etc. So to know what's going to be most important for your entity, you need to start planning now, I guess, and come and talk to us. If you have any questions about this, feel free to call me. So Tom, I'm looking forward to seeing what the poll results are saying.
Well, we've the last question which we asked was around the issues and concerns. The three main issues were, number one, disclosing additional information, which was almost 50% of respondents, which is no surprise there. That is typically number one concern. Consolidating financial statements and restating historic numbers. So if restating historic numbers is an issue, then Jimmy did outline some good kind of incentives that can help there. I think we've got a little bit of time left, so I might fire one or two questions if that's okay. In terms of disclosures under simplified disclosure regime, is there much difference between SDS compared to special purpose?
So when it comes to the disclosures in a special purpose set of accounts, the first thing I would say is there's no such thing as a standard set of special purpose accounts. So there's judgment involved in what you can disclose or will disclose in your special purpose set of accounts. But when you move from special purpose to an SDS set of accounts, SDS is a lot more prescriptive. So there's a lot of entities that have been doing special purpose reporting, but whose notes will reflect quite good level of disclosures. So they might have notes around all the material numbers in their accounts. They probably should have, if they lodge their accounts, some good disclosures around all the estimates and judgments in their accounts. So you'll find for those entities that are already disclosing quite good quality information around material items and significant estimates, judgments, etc., they might not have an enormous amount of extra disclosures to make when they go from special purpose to SDS. Some special purpose preparers will only have 1 or 2 pages of notes, will have basis of preparation, maybe one accounting policy, and maybe one breakdown of one number in the accounts. These entities who've chosen not to disclose anything really in the past, they might find there's a lot more to disclose. So there's not going to be a one model fits all in terms of how much more disclosures will I have if I'm going from special purpose to general purpose tier 2.
And another thing, a question I think is quite relevant is just around AFSL entities. Do they need to prepare general purpose accounts if they're only lodging a balance sheet and P&L?
So this is a question I've had quite a number of times. Why would an AFSL entity going forward need to prepare general purpose accounts if they're only lodging a balance sheet and a P&L, or if that's the requirement in the law? Well, the FS70 form, which an AFSL holder has to lodge, actually does say that the P&L, the balance sheet, the accounts that they prepare need to be in accordance with Australian accounting standards. And so I've also had some discussions with ASIC around this. So ASIC is still looking into exactly what the framework will be for AFSL holders, but ASIC is very much of the view they are not going to change their FS70 form, for example, to say actually AFSL holders don't need to prepare general purpose accounts. So an AFSL holder will be required by law to prepare financial statements in accordance with Australian accounting standards. So that means general purpose.
Okay, thanks, Renee. I think we're pretty much close to time, so I think I'll just we'll just wrap it up there. Just like to thank everybody for their time and for joining us today. Hopefully you got some value and some benefit from the session. Also like to thank Renee and Jimmy for that very informative session. Please feel free to reach out to Renee and Jimmy. They're more than happy to help you out with any issues and concerns or problems you're encountering with adopting the new requirements. You can also see on our screen there that we've got some upcoming sessions. Next month, we're running a webinar around valuation of assets, which will be relevant to anybody on the call who is preparing their impairment assessments for June reporting. And we'd also like to get your feedback in terms of the quality of the session and get your ideas in terms of how we could improve it for everybody. So please feel free to fill out the feedback surveys. So with that, I think that's pretty much a wrap. So that's goodbye from me, and until the next time, everybody take care. Bye bye.
Thanks everybody.
Bye.